Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. In this episode of Exposed by Math, I want to do something because I see this all the time on the internet forums. I see this all the time with even with some of my clients and my friends. They still don't understand some of the basics of how math works, especially when it comes to the tax system in the US, which means they believe some things that are not fully true or accurate. So in this video, we're going to show and talk about some of those things that people believe that are not true. So let's get right to it. What is a progressive tax system? Well, in general, it just means you have a lot of different buckets from small to large. And as you move up in buckets, they charge you more money. So you have a 10% bucket, 12% bucket, 22%, 24, whatever it is. And today's system is a fewer buckets. I think in the 80s, there were like 15 or 16 different buckets. It was designed so that as you move up in income, you pay more of your fair share so that because what they're trying to say is if you're poor and you're making 20 grand, you shouldn't pay a lot. In fact, most people can get a negative tax rate in America with all the deductions and the standardized deductions you get and the deductions from your children and stuff like that. So if you make very little income, you can actually have a negative tax rate, but we're not going to cover any of that. But in general, you move up, and as you move up, you're paying a bigger percentage of the last dollar you make into that bucket. And I'll show you real quick what that means. I'm not going to go over all the details. You can pause this and look at the numbers. This is the 22 numbers, and you can see there's different values for single, married, head of household. I'm going to look at numbers that basically revolve around the married couple between this area here. And why do I see this a lot? Some people still think taxes impact things like should I do a Roth versus traditional? The other way you can say that is should I pay taxes on the seed or should I pay taxes on the harvest? Most people still get that wrong. I created a video. It's in another Exposed by Math video. You need to watch that. The next question is sort of related, but people don't understand how taxes work today while you're working versus your retirement when you're not working. And they still get those confused and they don't understand how that impacts your investment. So we're going to talk a little bit about that. Obviously, there's another concept of, hey, the taxes are really low now. It has to go up in the future. While we don't know what the future holds, it's possible it can go up, or they'll just change it around where you get different type of deductions and you're really not going up or down. It's just really the same. A lot of people always believe taxes will always go up, and that's not true. So let's go to Excel and do some math. We got Excel open, so let's go over the first example. When you're working, let's suppose I'm closer to retirement. I don't care if you're 55, 60, 62, whatever it is. You're closer to retirement. Let's say you're making 100 grand. Or let's say you made 105 grand. It doesn't really matter. But if you made 100 grand, you're in this tax bracket here. You're married. You're making between 83 and 178. You're in a 22% bracket. But if you made in this bracket, you can see that your effective tax rate while you're working is 33.22 because your tax rate is based on the scale here, right? It's 22% of any number above this number, and then it's 12%, whatever. You have to add all these up. So I did the math for you so you can sort of see that. But your effective tax rate is only 13% of your 100 grand. What people don't look at is this. If you save money in your 401k plan, and let's say you made 105 grand, but if you put away the $5,000, you're saving yourself the 22% that you will pay on that $5,000. So the difference between that and this is where this money goes into a 401k plan. It saved you 22% of that money you put in. Okay? I want you to remember that. Now, why does this matter? When you retire, for example, let's just start off with a simple example. Let's assume that your retirement income is close to the income that we use, which is this $100,000. When you retire, assuming you don't have another job or anything else, you're going to have to withdraw money from your retirement account. I use an example over here, but let's tone down some of the numbers. You got a $2.5 million retirement portfolio. You doing a 4% safe withdrawal. That's $100,000. That $100,000 is taxed at what? Wild guess? Anybody know? Anybody know? But it's safe to assume it's going to be somewhere near this number. So let's say your tax liability is 13, right? 1,222 roughly. In retirement, when you're paying taxes on this 100 grand, you're not paying taxes on. This is what the internet does. They do this. Oh, what bracket are you in? This is the internet. Hang on, I can't even spell. Right? They use internet math. So that is the problem with the internet. People don't understand what the tax rules are. And they just use this number, they tax it and saying, oh, you overpaid, you're giving the government $22,000. Maybe you should have put some of that money in the Roth. Or maybe you should have used some tax shelter where you could have got tax-free money. So that's where the internet just goes off on this weird tangent and they just want to prove a point. Sometimes maybe it's just a sales guy who don't want to do the math because he's trying to sell you something. But this is what really happens. Okay, what's the point here? So I want to cover 2 points. In this example, if you spend a whole lifetime earning, let's say close to $100,000, you retire, most of the time you're paying 13%. Most people when they retire will only need to live off $70,000, right? It's really a percentage of your last 5 years' income. Most people can live on 70, 80, or 90% of what they were making in the final years of work. So if you did some simple math, if I was making 100 grand when I'm 64 and I retire at 65, I may not need 100 grand in retirement. But even if you did, if you use the full value, your tax, you see this number? The difference is always cheaper in retirement because the retirement uses the effective tax because it's a progressive system. When you're saving money for your 1K plan, even though it's a progressive system, it comes out of the last tax rate you were in. This stuff has been around for 40 years and people still get this wrong. And this is why you need a financial coach. You listen to people who give you bad advice, who don't understand basic math or don't understand the tax system. Get yourself a good CPA. Surround yourself with people who actually know their math and understand how money works. And I don't have a lot of clients that do this, but if you made $100,000 and you paid an effective tax rate of mostly 13% while you're paying into the system, effectively, even if you withdraw $250,000 in retirement per year, your effective tax rate is still lower than the tax rate during your working year while you're putting money in. Because while I'm in a 24% tax bracket, if I was withdrawing $250,000, my effective tax rate is 19%, which is still lower than this previous bracket here. And that surprises people. But mathematically, I can tell you, there's not a lot of people who make $100,000 and then when they retire, they need 200 something to live on. Now, it could happen if you got a pre-existing medical condition or you have a family history of everybody dying at, let's say, 71 and no one ever lives past that. There are reasons why you want to withdraw more money from your retirement account because you know that you're not going to live to 99 years old. Your expected life expectancy is much shorter. So there are some people who actually do need to pull out way more than what most people, like let's say, made in the last 5 years prior to retirement. But those are outliers, those are anomalies. But even with the anomalies, generally speaking, the math is still lower. Now, there are some other factors that makes it a little bit harder to predict. And I don't want to turn a blind eye to it. If you lived in a state with no income tax, then of course this is easy to do the math. But if you work in a state with no income tax, then you retire in a state with a state income tax, then it can work against you. Then it is possible for you to be in a higher tax bracket when you add up the federal and the state. Now, but let's reverse it. But if you lived in California and New York while you were working, which is more likely, because those were the high-paying jobs, and you retire and you move to a place with no state income when you retire, which is why Texas and Florida are that way. It's more likely that you're going to retire in a state with no income tax, like Tennessee. Therefore, the math is actually working for you now. Because in your working years, you are probably in a much higher tax bracket. It's 22 plus whatever the state was charging. And in New York State, you can pay anywhere from 9 to maybe 10%. I think California is about 10 to 11%. So you can see if you're in the 22% bracket, in theory, you could have been really in a 31% bracket because 22 plus another 9 or so for your state. But remember, you don't have to retire in that state. You can move to a non-state tax place of living. But anyway, we're not going to go into all the details, but I want to let you know that that's an option. With that being said, I hope I can explain to you or prove it to you that the income that you get from these tax-deferred accounts in retirement, generally speaking, will be taxed at a lower rate than when you were working. And I know a lot of people don't believe me. There are going to be a few people who will pay more, and I explained it because you moved to a state with income tax or some other something happened. But very rarely does that happen. More than 90%, I believe, are going to be in a lower tax bracket. So that's the end of this video. Please comment below. If you never understood this, watch the video over or go and watch my other video, Taxing the Seed versus Taxing the Harvest. Hopefully by the end of these series, you will actually understand it. And comment below. If you learned something, tell me you learned something. If you don't agree, and if you actually can prove the math, I would love for you to explain it to me. Maybe DM me or reach out to me on Facebook or create a video, and I would love to see the numbers and the math. But this is how it works. If you ever do your taxes, you'll see that most people don't pay whatever bracket you're in. I don't pay 22%. I know my effective tax rate is much lower. In fact, last year, I think my effective tax rate was like 4.5%. But in any case, I'm not here to argue all the tax things you can do. I'm not a tax accountant nor CPA, but I know that when you do your own taxes, you have a better visibility of how it really works. But thanks again, guys. Hey, if you want to win with money, reach out to me, get a financial coach, or work with somebody who actually knows this stuff. Don't forget, let's do this together. Let's do this $1 at a time. And have a good day. Bye-bye.